right, wholesale prices fell for the first time in almost 3 years. Actually, in the negative territory for the first time in almost 3 years for April. They've been falling consistently for the last 11 months. And the reason, of course, is softening global commodity prices, which have brought down the cost of food, fuel and other input costs for producers. WPI inflation has been on a declining trend in the last 11 months and came in at minus 0.92% for the month of April. This is the lowest print for WPI since June 2020, when inflation was at 1.81%. WPI for March was at 1.34%. So the high base at 15.38% in April 2022 has also obviously contributed to the decline in the wholesale inflation price in April this year. But April also saw prices easing across commodities, food, non-food, fuel, power and manufactured items. The deceleration in WPI comes in line with the easing of April retail inflation, which came in at an 18-month low of 4.7%. Now, the drop in headline inflation also boosted financials and bonds, with both recording sharp gains on Monday. The yield on the benchmark 10-year government bond fell to below 7%, increasing the value of bank bond portfolios. Harsh is joining us with more.
Well, the Indian 10-year bond yield has fallen below 7%, first time since March, April of 2022. So that's a bit of a benchmark there. Why is this happening? Well, globally, central banks are coming with a slightly less hawkish commentary, and that means that we will see going forward that central banks are less rushed with regard to any rate hikes. They are willing to wait and watch as to how the current rate hikes have played out with regard to economic metrics, and once they have a look at that, they will reassess whether any rate hikes, if at all, are required. So that's one key positive. So globally, we've seen bond yields come off, and that has aided Indian bond yields as well. So that's point number one. And point number two is, of course, with the financial problems happening currently globally, we've seen a few banks face some financial problems. We have seen central banks again get cautious. So those couple of factors playing out in terms of how central banks are viewing this, and which is why we're seeing bond yields come off. Now, in terms of the impact, bond yields have an inverse impact with bond prices, and that means that as bond yields start to go down, bond prices start to go up. So that inverse relationship is what has really started to play out. So we are seeing bond investors make a little bit of returns, which is a positive. And as bond yields come off even more, if at all they do, bond investors will make better returns going forward. So that's one positive. The other piece is that as bond yields get lower, we also see corporates getting or borrowing at lower rates. Of course, a bit of that is linked to how the RBI plays it out as well, but definitely that benefit comes on corporates as well. Lastly, as you get lower yields on bonds, investors prefer parking funds in equity markets, and that is the other piece. The hunt for higher returns will start to play out in equity markets as well. So these are 3 to 4 factors that ought to play out as bond yields start to come off.
Okay, so bond yields are starting to come off. Harsh there with all the latest, but let's get the big picture. State of economy. Garima Kapoor, Chief Economist, Elara Capital, with me. I'm also speaking this evening with Suvodeep Rakshit, CNA Economist at Kotak Institutional Equities. Welcome to both of you, and thank you so much for joining us on ET Now. So a lot of data in today. Trade data is also in today. But Garima, I'm going to begin by looking at the inflation side of the story. WPI numbers, yes, base effect in play. But, at a lowest since July 2020 on the back of benign inflation numbers, headline inflation numbers as well. Are you seeing a trend firming up here, more and more reason for RBI to extend its pause?
I would reckon yes. Largely because 2-3 factors actually are contributing to this. Yes, base effect apart, what we're also seeing is we're starting to see some softness in data that is coming from China. The latest print on the import data for China, as well as the credit offtake data and the PMI data, were much below market expectations. That has set in a weakness in the base metal prices. So actually, if you look at the Reuters CRB index, it's down by about 2% in a week, to 6% in a month, and more than 16% on Y-on-Y basis. More so, if you look at the trend of certain specific base metals like nickel, you're seeing that nickel prices decline by nearly 10% in a week. So you are beginning to see, apart from crude oil prices, other commodities also beginning to kind of come on a deflationary trend. Now, if you look at the global food price index, the FAO index, it's down nearly 20%. Now you've seen agrochemicals, fertilizer, almost every other input price decline as well. So base effect apart, I think a large chunk of the current momentum that is contributing into the current numbers, especially for WPI, should sustain and should give comfortable position for RBI, particularly MPC, to kind of extend that pause. I think particularly the fact that your crude oil has corrected from 83, 85 to about below 80 levels, and the current prices, along with the fact that you do not see on immediate basis any signals that these prices are going to turn around soon. So I think enough reasons for MPC probably to extend their pause.
The inflation pain seems to be petering out. Suvodeep, how do you see the slew of data which has come in today?
I agree with Garima saying in terms of the inflation being a comfortable zone now, as pointed out by the WPI, earlier by the CPI. It's now off the peaks, right? In terms of the comfort of the RBI, it wants it below 6%. In terms of the CPI inflation, we have a print of 4.7%. I think all this is good. So I don't think there is any reason for the RBI to kind of be hawkish about the numbers per se. What the RBI would probably be hawkish about is in terms of the outlook, which is basically that we don't know how the monsoon is going to pan out, and obviously with much of food being majority of the basket in some sense for the CPI, that needs to be seen. So with a erratic monsoon, you could have the most of the short cycle crops like vegetables and fruits start to see a price increase, which anyway, till around July, August, sees a seasonally uptick on a month-on-month basis. So you will have to look through these numbers in terms of, how high are they going? And for the RBI, it becomes cautious. I think the policy becomes a more cautious way of looking at things rather than being hawkish. So they are going to probably signal that they are going to monitor inflation. They are not out of the woods in terms of the inflation prints, no matter what the WPI, which moves into deflation because of a favorable base, or the CPI, which also has a favorable base, but you have on the CPI at least a kind of outlook which could be on the higher side, and you need to look through the next few prints, especially through the monsoon, to get a better sense of whether this number is something that remains on the lower side and definitely below the RBI's upper band, which is the 6%.
The other part of the puzzle, so to speak, and interesting data coming in is trade data, which has come in today, which shows India's merchandise and service trade deficit has fallen to a 21-month low in April, partly due to lower oil imports. Now, Garima, lesser imports is usually seen as a good thing, right? A shrinking trade deficit. But it's also a sign sometimes that demand is slowing down. How would you look at it?
See, the part of the reason why your trade deficit is corrected, of course, is because your oil imports are coming off from a very high base, as well as various commodity prices are also correcting compared to same time last year. But if you look closely, it's the exports also that have been degrowing very sharply at about 12%, particularly because the global trade volumes have been on correction phase since November 2022. Most importantly, if you look at the core imports data that we track, that is non-oil, non-gold, which is considered to be a fair proxy of the demand in the economy, that has been on a downtrend since January, partly indicating that the domestic demand conditions have started to soften. Now, if you correlate this with the recent IIP print that you saw on Friday, consumer durables and non-durables both have been on a downward trend. So if I just join all these dots together, there are clear evidence that the discretionary demand, particularly the goods side, is slowing. We already have evidence on the rural side, basis the channel checks, that perhaps the month of April was extremely bad in terms of rural consumption, particularly your staples. And on top of it, you have an additional worry, the global demand is also softening. So while I would look at this data positively from an external point of view, because it ensures that your current account deficit for financial year 23 will be close to 2% compared to the highs that we saw in 2023, I think what it also does, it signals that there has been a reasonable amount of slowdown that is setting in, particularly in demand conditions domestically.
Yep. Suvodeep, your take on the trade data, and we've seen this theme of exports getting hit over a few months. Geopolitical reasons have been cited, etc. If there's a global recession, then obviously a lot of countries don't want to buy more stuff. So exports are naturally going to get hit. But how do you see the trade deficit data that has come in today?
So if you look at the trade deficit or the non-oil export, non-oil imports, which should kind of give you a better picture in terms of what the demand situation is globally or domestically, there is not much difference that you would see in terms of the January, February versus the April print. March is always an outlier because it's a year-end number. So obviously much of these numbers are inflated in some sense. So if you look at the export and the import, especially on the non-oil side of things, it's not too different actually. So in some sense, the kind of pressures that we were seeing, for example, we all know about the consumer durable kind of a slowdown that we are seeing, that is getting mirrored in the April numbers. So yes, there is a large price effect, which is where the year-on-year numbers, when you see in terms of the export and the import, those kind of trends bear out in terms of the price effect. There is a slowdown that has been underway over the past few months, which is also visible. But I don't think it has worsened in the April print. I think the way to look at it is look at the January print, look at the February print, and then look at the April print. It's kind of in line in terms of both the non-oil export, non-oil imports. Obviously, imports, one point that should be noted is that when you look at the April print and you look at, let's say, something like machinery or a transport equipment, which is basically to deal with the auto sector, these, if you look at the transport segment, there is a sharp drop that you would see from even the January and February levels, which kind of indicates that there is a bit of a slowdown, a bit of a growth challenge that possibly is visible when it comes to the April numbers. But again, it's not a 1 month data that we should be basing all our facts on. A steady decline in, let's say, domestic demand would have to bear out in the following months also. But for now, I would say, from a very broad perspective, January, February, whatever trends we have seen in terms of consumer slowdown, etc., is probably showing up. In terms of exports, whatever we have seen in terms of the global side of things, that's also showing up. But I don't think incrementally there is a very large slowdown. But yes, some signs which we need to kind of monitor from a domestic side of things over the next few months.
Thank you so much, Garima and Suvodeep, for joining us on the show as we look at the state of economy. Interesting data in today, WPI as well as trade deficit. Okay, shifting focus to mutual fund space, where cash holdings have hit a 2-month high. What are the sectors that have logged inflows and the ones that have witnessed outflows? Sharath is here to put it all in perspective.
Well, yes, in focus we are having the top 20 mutual fund houses and their average cash level holdings, and you see the cash component has actually gone up by 60 basis points to almost 5.6%. Now do remember, this is coming at 2-month high levels. That means the cash reserves are actually being conserved because Nifty has also risen by almost 4% in the month of April. Now this is the most in the 5 months. Now let us look at how the flows have come. Strong inflows coming from the DI segment. If you look at it, for DI segment, it's almost 2,217 crores of inflows in the month of April. But the FPI, that's the number which you're looking at, 11,631 crores of inflows have come in the FPI segment. Now looking at the trend of the average cash holdings in the mutual fund houses over here, we see that has largely been in the range between 5.3 to 5.5% over the last 12 months. But we see for the month of February, it went up as high as 5.9% at a multi-year high, and then coming down to 5% in the month of March, and then again rising in the month of April at almost 5.6%. Now, apart from this, which segments saw the inflows coming in? Over here, we see financials, industrials, auto ancillaries, and staples seeing a majority of inflows coming in, while for the outflows, it was the names for the second straight month. It is IT, telecom, utilities, and also the consumer discretionary space.
And